What is an indexed universal life, otherwise known as an IUL, also known as a rich man's Roth? What is it? So many people ask me that as a financial strategist, and I absolutely love showing people the laser fund. Did you know that an index universal life has 7 living benefits? If you get the right one. Not every life insurance carrier gives you 7 living benefits. There's just 1 or 2 that do that. So listen, take about 5 or 10 minutes with me right now, and let's take a look at an illustration of what an indexed universal life is. All right, so I am going to share my screen with you. Let's see if I can do this. So, if you take a look at my screen, this is actually a client of mine who who's using an index universal life as a tax-free retirement plan. He's in good health. He is 57 years old and he wants to retire at age 66. So, what he's doing, he is actually taking his old child support payment. So, his son just turned 18 and he was paying $1,000 a month towards child support. He said, you know what, Richelle, instead of paying that, now I can pay myself first. So, he's just transferring money that he was already doing and using it as a way to catch up with his retirement. So, I think the first thing you'll notice about this is that if he passed away, his son would get $400,796. That is enough to cover the rest of his mortgage and help his son through college, and also leave some over for final expenses. So we sat down and we added up how much life insurance he really needed. And to cover those major things, the balance of his mortgage, the rest of his son's college education, and his final expenses, we learned that $400,000 was an appropriate amount of life insurance for him to have. Second thing we did was, hey, when do you need to start taking money? And do you have any other money coming in at retirement? And we found out that he had a gap where he needed about $900 a month to make sure he was financially independent. He has a pension, he has Social Security, and he would have had to go back to work to make up the difference of about $900 a month if he didn't do this plan. Now, can you imagine being 66 years old and not having enough money and having to go back to work part time just to make up the difference? Now he doesn't have to. So this was a wise transition of money. So you can see he stops paying into the policy at age 66. Now, at age 67, he's able to turn on a lifetime tax free income of $904 a month. That is going to pay him for the rest of his life tax free. Now, people say, how is it that this income is tax free? Well, because we're leveraging life insurance loans. For more information on how that's done, a little deeper dive, reach out to me at Rhema, RHEMA, Financial Solutions with an S.net, and book a phone call and then book a Zoom call so you can see this for yourself. But guess what? It not only allows him to get that tax-free income, but he's also going to be able to be his own bank with this life insurance policy. What does that mean? That means you have the ability to borrow the life insurance company's money as your money stays inside of the policy and continues to grow. And you can access that money tax free as well. So, as you can see, at age 74, if he leaves his cash value alone and lets it grow, but he can continue to take his $904 a month, but the cash value will still be growing in his policy as he goes along. So there's $54,223 when he's age 71, and then it grows and grows and grows. And at age 88, he has $216,890 to be his own bank. Now, listen, how many living benefits is that? Well, there's one benefit if you pass away to his son, right? But there's well, that's actually two living benefits because you have passive income, right? Which is the $904 a month, and you have cash value, which is growing up to over $200,000. So we counted two living benefits so far. Are you with me? But we're not done yet. If he is diagnosed as terminally ill, he can leverage the death benefit of this life insurance policy, which means he can surrender or partially surrender that $400,000 worth of death benefit and take $178,509 in a tax-free lump sum for himself. Now that means he's leaving about $200,000 worth of death benefit back, and he's taking $178,000 and some change for himself. Are you with me on that? Now that's three living benefits. He has chronic illness. What is chronic illness? It means you can't do two out of the six daily living tasks. And the doctor says you need nursing care, part time or full time. It can be a family member, it could be a professional nurse. If that happens, he can file a claim against the death benefit and take $3,189 per month. Remember, he's leveraging that death benefit. So he's dwindling that death benefit down, but he's going to leave about 20% of it back for life insurance. And that will pay him for 4 years. All right. If he became critically ill, think about the top five critical illnesses: cancer, a heart attack, heart disease, a stroke, kidney disease. There are 13 different health triggers. He can leverage that death benefit, file a claim against it, and be paid $166,771 as a tax free lump sum if he became critically injured. Now, this living benefit is what separates this company from the masses. There are no other life insurance companies that pay a critical illness benefit except this one. Don't you want to know what it is? Well, guess what? Reach out to me. Rama Financial Solutions with an S.net. Critical illnesses are head trauma, severely burned, paralyzed, or in a coma. Same amount, $166,771. If the doctor diagnosed him with Alzheimer's or long-term memory loss, he could do two things. He could take $161,282 as a tax-free lump sum, or he can take the critical chronic illness monthly payout of $1,389 per month. So he has a choice to take a lump sum or a monthly income if he was diagnosed with Alzheimer's. So let's count this up. We have the tax-free income that pays you forever, right? That's a living benefit number one. We have the cash value that keeps growing even though you're taking your income so you can be your own bank. That's living benefit number two. We have the terminal illness. If the doctor told you you had so much time left to live, but you're still living and you need the money, that's living benefit number three. We have chronic illness, long-term care, that's living benefit number four. We have critical illness, and that's living benefit number five. We have critical injury. That's living benefit number six. And guess what? We have Alzheimer's. That's living benefit number seven. Seven living benefits on one life insurance policy. Now, some of you are probably saying, you know what, Richelle, that's all good and fine, but I don't know if I could actually put in that much money. Do I have to put in $1,000 a month? No, you don't. All right. The average person can set aside at least $200 a month. Now, think about the math. This gentleman's 57, so he only has a little bit more than 10 years before he needs the income. So he's playing catch up, right? So he has to put in at least $1,100 a month to catch up. But if you're 45, you can cut that in half and still get down the road to about that destination. If you're 35, I'm gonna always tell you don't put in less than $200 or $250 a month. Why? There's a principle called tithing to yourself. Pick up what I'm laying down. And it's also called paying yourself first. The principle is take 10% of every dime you take in and set it aside for your future self. Does that make sense? So here's the way we calculate that. If your bills are $2,000 a month and your income is $4,000 a month, 4,000 minus 2,000 is what? 2,000. So that means you have $2,000 a month cash flow left over at the end of the month. The principle is take 10% of your cash flow and tithe it to yourself. So that means you should be able to comfortably do $200 a month. Are you with me on that? So I'm going to give you a challenge right now. Add up five things: your house or how much you pay to live, your home transportation, personal care. What is it? Home transportation, personal care, food, and clothes. Your home, how much does it cost? Your rent or your mortgage, your food, your transportation, and your personal care. Add those up, add about $100 a month cushion, and that's going to be your monthly expenses. Now stop what you're doing, take a look at your pay. How much net income do you take home each month? I'm going to ask you to take your expenses minus your net income, how much you take home per month. Now, how much cash flow do you have coming in each month? Do you have it? Go stop what you're doing and write that down. Now, I want you to take 10% of your cash flow, and I want you to put your hand on your heart and make this commitment. I tithe to the God inside of me. I tithe 10% to the God inside of me. So I want you to take 10% and I want you to commit that to a tax free strategy. Something that'll give you life insurance, tax free income, cash value, and living benefits. Does that sound like a deal? Well, if you've made that commitment, you are ready to talk to me. Reach out to me again at Rhema, RHEMA, financialsolutions.net, or send me an email at Rhema, RHEMA, financial coaching at gmail.com. Yay! All right. Sitting outside of the restaurant from the beautiful Virginia Beach, Virginia. I can't wait to hear from you. But listen, I want you to go to one more video before you call me. Take a look at the video that says, "What is a Roth IRA?" Watch these two videos, then you're ready to talk. Love and blessings. See you soon. For more information, scan this QR code and talk to Richelle at Rama Financial Solutions.net.